valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a financial mediator and business valuation expert in St. Louis, Missouri. Today, we're with Nolan Bradbury. He's located in Seattle, Washington, and the founder of Bradfield Accounting and Advisory. He has 2 decades of experience and offers clear and practical financial advice to business owners. And in this episode, we're actually talking about how to clean up your financial situation to sell your company. Welcome, Nolan. How are you?
I'm well. Thanks for having me.
Well, this is awesome. We were going to talk about a lot of different topics because you have skill sets that cover a lot of different areas. But I recently had a client that came to us, and I would say he is very typical in the types of clients that we're seeing, in that he said, soon I want to sell my company. And, people have been asking me about it for years, but I just never did anything. And so he's like, what would be the steps to do that I could go sell my company? And I was like, and I kind of looked around, and not only was the physical space, maybe needed to be cleaned up, but we talked about his books and how he was keeping his own records, and, and he had spreadsheets and he had files, right? Lots of client files that were very valuable, some IP maybe, but in general, his question was like, how do I clean up my financial situation? And it wasn't in that manner. It was, what do I do if somebody comes and when do I need to get prepared? He just called me and said a buyer came 2 weeks later. And now we're in emergency mode because we didn't really do anything for the last 2 weeks. So that's what I thought would be kind of an interesting conversation, because I think some people don't understand what that looks like. And you're kind of an advisor that's coming in and helping businesses in that space, right? You're kind of working with some business owners in that space.
Yep. Yeah, the situation you just described is oddly very common in the sense of you'd be amazed at how frequently I speak with someone and they say, I'm looking to sell, I think I want to exit. We talk about what that timeline looks like, and then they put it out in the universe, and then a month later, someone's knocking on their door. Now, that's not always how it works, but it does seem to kind of somehow shake out like that, which is all the more reason why it's really important that if you think you're wanting to exit in the next few years, that you actually start thinking about it and preparing for it. The runway to exit needs to be a lot longer than most people tend to think about. It's not like, oh, I'm going to put the for sale sign out and it just happens, right? You need to be focused and intentional about presenting your company in the best light. Similar to the way you would stage a house to sell it, right? You need to somewhat stage the business to attract the right buyer and the best offer you can get.
Well, and I think that what was interesting to me is literally, it was just really a friend of a friend of a friend, right? It was just a casual, hey, come and talk to the business owner and maybe, talk to them about value and what's the value and how can we increase value over the next couple years, right? Yeah. Years. And I mentioned to him oh, you should maybe, just talk to people in your industry or, start talking around. So of course that created conversations that did create a deal. But I think that it makes me even go back further, because now we have to do a lot of this immediately, almost yesterday, right? And we literally walked away from the meeting oh, that was great. Call me in a year, or I'll see you, at the end of the year when your finances are done. We'll look at the value, benchmark it for the future. But what we didn't cover is what are the first steps a business owner should take to clean up their financial situation before sale, because we thought we had years. Really, we really did.
I think this is an important thing to understand, is that as when you start in and you start the process, you have a PSA, maybe you have a letter of intent in place, and the due diligence process begins, right? I think as business owners, we tend to think about it from the perspective of, oh, here's where I'm at, this is where I'm going. That's what they're really interested in, right? They're acquiring me for the opportunity that I possess, or the what I could be down the road. And that is true, but we tend to underestimate the importance of the last few years worth of history that has gotten you to this point to actually substantiate what you're projecting is going to happen going forward. So that's why that sort of multi-year runway is important. So if the first thing they're going to ask for in the due diligence project or process is, hey, give me the last 3 years worth of tax returns and the last 3 years worth of financials, and what you give them is garbage, well, that's a really bad first impression, and it sort of undermines again what you've presented to them as the real viability of what they're buying. And so what you need to start with is really taking shape of, what do I have, what have I done or not done, where are the skeletons hidden, what have I maybe kicked the can on from a compliance perspective. I would say the two places we see most often hold up or hinder the exit process are inaccurate financials, meaning that what you had in the past does not actually jive. And we can talk a little bit more about what that really means in more detail, but also two, known liabilities. So meaning that you haven't necessarily been in full compliance, and that's both at a federal and state level. It actually tends to happen more at a state level. As businesses grow and scale, it happens very quickly, and staying on top of state and city and local requirements is not always on the forefront of everyone's mind as they're making more money. And then you get to an exit and suddenly all these things come to a head. And you're the buyer, you don't want to necessarily be absorbing a bunch of unknown liabilities that are sitting out there. So those are the types of things that we need to start by assessing, where do we need to triage? What do we have to focus on? Obviously, if we have more time, it's not as big of a rush, but in the situation you described, it becomes very important to sort of get on top of that very quickly and take shape and take accountability of, what is the real exposure here? How do we minimize it? And how do we do that quickly?
Well, and I think the business owner, when they're approached in this manner, right? They meet with me, they're told, okay, you got to do these steps, and then we'll either go out and find buyers, or a buyer's going to come. So now the buyer comes very quickly, right?
Yeah.
And they're just so excited, and they were told that it was going to take so long, but it's right there. So then the buyer's like, and the buyer knows, right? That
Mm-hmm.
you're a first time seller. Okay. And the buyer can see that that is your weakness, and they're going to potentially capitalize on it. But you're initially going to be like, oh, let me just send you my tax returns. Let me
Yeah.
just send you my internal financials. And
Do
I
not do
know
that.
right, right.
Do
And
not
I
do
said,
not do that.
do not do that at
No.
all.
No.
So I said to them, I said, in the valuation, we're going to see those two documents first, and we're going to be like, why don't they correlate?
Yeah.
Right.
Yeah.
And so I think that even one of the first things, and that's where I first see it, you have a tax return, and the person who did your tax return does not go back to your internal books and then make the right journal entries to mark your books to what your tax return was or your filing was. And so you have a mismatch in there. But what are some other common financial issues that you see that could hinder the sale of a business that we also would need to clean up in some capacity?
Yeah. So I'll preface that answer by saying I think it's important to understand that when we look at financials, there's 5 areas. They're actually called the 5 financial statement assertions, meaning that there are 5 different ways that you really need to evaluate financial statements. So the first one that we probably all think about the most common is, are they accurate? Meaning, is the number in there the right number, right? So that's fairly obvious. But there are other things like completeness, meaning, is every number that should be in there actually in there? So if I have a bank transactions, do I have every transaction recorded for the month, not just are they the right amounts? You also have existence, like, do these assets actually exist? Do these liabilities actually exist? You have rights and obligations, meaning that all the assets and liabilities in the financials actually belong to the company, right? So there's not the owners and they've separately held off the books and he's sort of putting them in the company just to make things look better. And then lastly, we have presentation and disclosure, meaning how is the information actually presented? Is it in accordance with either GAAP or some other form of accounting method that's accepted? And that's sort of a separate conversation. What method do you have to report on? But so when you understand those 5 things, then you have to go, Well, all of these areas can be a trip up, right? When we're looking at how we evaluate these financials. And so it isn't just one, it's the totality of all of them that typically gets people in trouble. And I think as business owners, we go, oh, well, all my information is there. Yeah, but that doesn't mean it's presented correctly. Do you have, I mean, I've seen situations where revenue is recorded as expenses. I've seen assets put on the books where they shouldn't be. You'd be amazed at what gets done and never sort of captured or sort of looked at ever again. And to your point about the CPA preparing the taxes, I think there's sometimes a false sense of security that as business owners we place on the CPA that, oh, well, they're a CPA, they're doing all the work. You need to understand what you've hired them to do and what their responsibility is. They're not going to take on more responsibility and liability than they've been engaged to. Their job is to prepare the tax return in most cases. They do not audit, they do not review the information you gave them. They're not looking to see if it's correct. They're trusting that what you gave them is the correct thing, and then they're completing the necessary forms as a result of that. So what's been presented on the tax return, it should be correct relative to what you gave them. But if what you gave them is not correct, well, garbage in, garbage out. And that's then assuming that what's on the tax return actually matches what's in your financial records or your accounting records.
Well, and I think that when we're typically looking at a business valuation and we're looking historically at the past 5 years of financials, right? And when you go to sell a company, you might look at a projection or the next 5 years. But when you're looking at the past 5 years, a lot of times people have tried to make sure that they pay less taxes. So they're doing like hyper expensing things, which could be legit, but also could be like putting a lot of personal expenses through the business. And one of the things that we had talked to the SBA recently is that they're going to default to looking at the business tax returns if you need to go in for some sort of business loan through the SBA. And so, it's kind of in doing this process, whether you do it in a valuation context, and you don't always need a valuation to go to market or to go to sell, right? What we use the valuation for is to prove up your projections or getting to that value, right? Or what's your trailing 12 months? Like, what have you done for me lately? And I think that people need to understand that, okay, let's clean up the books. But that process should get you to start to understand the significance of cash flow and debt and what it means for preparing for sale. And do you know those things? Like, if somebody comes in and gets a quality of earnings, they're going to want to know, what's your cash flow? Is it real? What is your debt? Is it real? And who's keeping what, right? That's part of what the seller and buyer are discussing. So how do you talk to the business owner and have them understand what's happening in their financials?
Yeah, I think, one of the things too that I think gets lost for a lot of business owners is we think of an exit as being there's only one way to exit, meaning I, as a business owner, am going to sell you my entire company, like lock, stock, and barrel for X amount. The reality is both you and I know there are many, many ways that deals get constructed. And sometimes we have to be creative in order for the numbers to work, in essence, right? So there's asset sales versus equity sales, and those differ. And so that the impact of what you described, cash flow and debt, has an impact on that and which way someone would want to go. You have differences in terms of why is someone acquiring you? It's important to understand that. So is it a competitor looking to acquire a certain intangible asset like a customer list from you, or are they actually looking to acquire people or processes? Because if you understand what they're looking to acquire, you can better position yourself and better increase the value of those particular pieces. You have to really understand, why are you exiting? How are you exiting? What is that sale going to look like in order to be able to best answer sort of what are the important pieces. Now, the reality is anyone who acquires a business wants to do as little as possible once they take over. Again, going back to the house analogy, very few people are looking to buy a house, pay full price for it, and then do a bunch of work to it. That's not the issue, right? Someone is like, hey, I'll take a fixer upper, I'll take it at a deep discount, I'll put the work into it and sweat equity. Okay, that's fine. But no one's going to give you full value or above and then also be okay with doing a bunch of extra work to get it to where the valuation said it should have been in the first place, right? And so understanding that piece of it, how that all factors into what you do in advance versus what you don't do in advance, right? Are they looking at just top line revenue? All these pieces come into play in terms of the way the deal gets structured and what you as the seller need to be really focused on driving. That being said, again, buyers want something that is going to be cash flow generating, right? Very few places are looking to acquire something if it's just hemorrhaging money. Now, again, maybe there's an intangible asset that they're looking to acquire that is the main reason. All right, there's a patent, a trademark, something like that. Debt is another one, especially recently with all of the SBA type loans that came out of the pandemic and all these businesses that have these really large 30-year loans right now. Those are incredibly difficult to get out of. People don't really realize the implications of those loans, meaning that you sell the business, it oftentimes means the loan is callable on that point. So you have to sort of figure out, like, do I have to pay this off? You know, is that part of the exit strategy, meaning that I have to get enough cash to be able to pay the debt, the SBA loan off so that I can then leave? All these things are really important conversation for the seller to understand, so they have the right expectations about, one, how this deal is going to look and what they're really going to get at the end of the day. Because unfortunately, a lot of business owners in their head, and I'm sure you've experienced with this, overvalue what their company is actually worth. They think it's worth a lot more than it sometimes comes out when you start running all the numbers. And a lot of that is because the financial records have never been kept in good working order to be able to give them a more realistic expectation of what that is at any given point in time.
Yeah, no. And I think that is typically what we see as business owners think that the value is far greater. They believe that every business is sellable, and, until they get divorced, and then it's worth nothing. But, I think there is a disconnect in the business owner understanding their financials, understanding their taxes, understanding what implication it has. And I think in some capacity, if you're looking at, and I bring up a concept of working capital only because if we look at the significance of cash flow and debt for a company, actually it's the working capital adjustment. So if we look at that in some capacity, this is what I'm seeing, that most like, I get a lot of calls that I have to go in and negotiate a deal that is currently in process. Okay. Mm-hmm. And they're at a working capital adjustment and they're supposed to maybe, close in a couple weeks or a month. Right.
Yeah.
And there's this hypothetical working capital adjustment. And I just want to talk about it a little bit because I think that this is why you need to know some of your financials, because a working capital adjustment is literally an arbitrary kind of math equation that they're going to use against you to adjust the purchase price. So if you don't know your numbers, or you don't go, so I would just maybe have a discussion about, like, this isn't just prepping your financials for this process. This is prepping you as the business owner. Like, do you know what these numbers are? Are you just handing over documents and you're getting stuck because somebody wants to buy you and you're just like, here's everything. And then it messes up the deal. And yes, a buyer in hand is really great, but how does a working capital adjustment come in there? Or just how does this work in these financials and exchanging them with the other side? Like, it's a lot of things that people don't understand. And this is one of them that I think creeps up on them. They're like, we have a deal, and now they want to do something different. Do you ever see any issues with the working capital adjustment?
Yeah. Starting with most people not understanding what it is and why it's in there in the first place, right? So true. I think this is upstream. There's a real, I don't want to say problem, but there's a struggle with business owners in that, like, they don't like accounting. And I understand that. Like, it's not like their favorite part of running the business. In fact, it's like the least favorite part of running a business. And so because of that, as human beings, we avoid things we don't like. So we don't necessarily focus on it. We see, oh, I'm selling enough, I'm profiting enough, that's great. Well, that all comes to a head when you get to these sort of discussions, right? And the financials are really what are being used against you in most cases, right? That the buyer is going to take your information and try to use it against you to drive down the price that they're paying. So for net capital, or excuse me, for working capital, what we're really talking about is the difference between your assets and your liabilities to a large degree. More specifically, usually it's your current assets minus your current liabilities. And what that's really basically saying is, do you have the ability on an ongoing basis to sort of use generated cash to cover your ongoing liabilities, right? Now, the reason this is important is that if I'm a business and I'm coming in and acquiring you, right, I'm outlaying a lot of cash. That also means I have to fill in any gap or any shortcoming on the working capital side. So if debt exceeds assets, that basically means like I'm going to have to bring more to the table. Well, spoiler alert, this is not going to be something that I just absorb out of the goodness of my heart and I sort of just go, you know what, I'll pay another X amount per month to keep this company going. I really like it. No, you know what they're going to do? They're going to drive down what they're paying you because that's where it's got to come out of. And
Mm-hmm.
so all these adjustments that we get to are I mean, they are somewhat arbitrary to your point, right? But it's a negotiation process on what is the ongoing maintenance of this company, what needs to happen to keep it afloat, and then how does that impact what I'm paying you or what I need to pay you, and at the same time allowing me to maintain the business to keep the doors open. And so we don't really think about this as business owners, right? Because this is in the kind of the minutia of things, but these are the exact type of things that will come back and be used against you if you're not prepared for it as part of this conversation.
Well, and I think that in general, people are trying to spend some of their cash, right? Or you're going to keep cash and you need to work down your receivables, but that works down your current assets,
Yeah.
right? And it is going to shift that working capital. I think that people should just be aware that, these are some issues that you should, whether you clean up your financials or not, you should have some of these discussions and be aware that there's a working capital adjustment because it confounds even the most sophisticated buyers and sellers. And it really is knowing your numbers or your value can help you negotiate and pivot when you need to. But if
Yes.
you don't, a buyer is going to use that against you. So,
I
yeah,
always think about it in this way. I apologize for cutting you off here, but like I think that
yeah,
the when you're selling your company, what you want to think about it as like you want to wrap up this present, like this package of all of your stuff. So all the documents, all the support, your tax return, your financials, your projections, all that. Think of it as this gift that you're sort of preparing and you're going to give to the seller, right? The prettier it looks, the nicer it's laid out, the better the wrapping paper, the more extravagant the bow. I know it doesn't sound like it's important, but it actually is very important because it adds to the credibility of your company. If you can provide financial statements that when the person looks at, there's not really any ability for them to chip away at or undermine the credibility of it, that's one less bullet they have in their chamber. If your tax returns are in good order and they make sense, that's one less thing that can come after you. If you've had conversations about why is the trend of this 8 months ago what it is, and you can answer it, articulate it very well and eloquently, then that's one less thing that they come after you. Think of it, they're going to come after you with all these things that are like these gotcha moments. The more prepared you are for those conversations, either in the room or with your team in advance, the better equipped you're going to look in those meetings, which is going to just, it may not increase the value of your company, but it's not going to negatively impact the value of the company and what it sells at. And that's, I think, the thing that tends to get lost is that it is this holistic package that you want to be putting together. And a key component of it is the financial numbers.
yeah, and in the right order because one of the things that I think are unique to you is that there you need to get a team in place. And at the point that you're calling an investment banker or a business broker, they're going to transact the deal. You're calling a lawyer, they're going to write up the documents for the deal. No one's going to help you negotiate that deal if the buyer comes and knocks at your door, right? You're going to kind of think that you need to negotiate that on your own, but this is a little bit unique of what if you it's almost like you're going to like a doctor for the business, right? How can a financial concierge, which is kind of what you offer, and we can talk about that a little bit, play into helping a business owner improve their financial health so that they are ready when that knock at the door comes. Because I believe that that knock at the door is kind of the future of a lot of transactions for smaller companies. And smaller is under 5 million in revenue, right? Which is
Yeah.
a lot of companies. But what is financial concierge services? And like, how would I, as a business owner, utilize that? And it kind of benefits me for sale as well.
Yeah. So I think there's two things that sort of important to understand. So one, it's really hard to be an expert when you're not an expert at something. So I know it's a bit of a Yogi Bearism, but like what I mean by that is uh, if I know I need to say work on my estate planning, right? I put this off. I need to get some wills in place, pay power of attorneys. I know I need to go hire an estate planner. Where do I start? Who do I use? How do I evaluate them? How do I know? Like, do I go to Yelp? And not to knock on Yelp, but like, is that where you want to be finding someone? Maybe you get a referral from a friend. How do you know that the friend's situation is relevant to your situation and the person you're getting is a appropriate size and competency? These are challenges that often prohibit people, business owners, founders, from acting upon the things they need to actually take seriously. And so as a business owner, we're so focused on our business that we forget about how it, like the personal side of everything, and how the flow from the business into our personal gets impacted. And then we have this financial house that is not in great order and we neglect it. And that ends up coming back to bite us, not just from the standpoint of like things like we're talking about here in terms of exiting the business and preparing for it, but after you've exited the business, how are you prepared? Have you had a conversation with the right people to know that when the check comes in or the ACH comes in, right, that it's going into the right places, it's been handled appropriately, you're not paying more in tax than you need to? Those conversations often happen very discreetly with independent advisors. And it's not that the advisors do a bad job, it's that they don't know the other conversations that are happening. And then that responsibility falls to you as the customer in this scenario, right? To basically quarterback all of this for yourself. Well, again, you're not an expert. And that's the real challenge. And this is where people hurt themselves, especially on something as massive as a business exit. Like, this is probably the thing that's going to contribute to your retirement the most, right? And you're doing it on your own. Like, would you general contract the building of your dream home? I certainly hope not. I think you would probably go hire a professional to do that. And so what we have found is a need that we can help business owners, particularly founders, with is stepping in and acting as their financial quarterback, if you will, meaning taking over the burden that comes with tackling these specific things for them: estate planning, business exit preparation, tax strategies, all these things that they can get done discreetly and independently, but that's not the most optimum way to do it. You want someone who's looking at the whole picture, coordinating all the things with all the specialists, and making sure that it's getting you to the right result that you want, whether that's personally or within the business. The unification of that is really key, and we've seen a lot of great success for people in that type of situation.
Well, and one of the other issues as we kind of talk about how to even get a hold of you, one of the issues is that in this space of kind of cleaning up everything, you also have to understand what you're going to take home from that. So a lot of times people are like, oh, they offered me $2 million. And I'm like, that's great. And
Yeah.
that's where that working capital comes into play, because it's like, well, are you keeping the cash? Are you going to have to pay off things? Are you going to have to pay taxes? Can you pay the taxes in 2 years? Are you going to have to do it all in this year? Can you have some prep for that? And those questions you don't have the capability of answering if
Yeah.
you got the knock at the door, and you just have to now. And I would encourage you to also, if you get the knock at the door, you don't have to just answer immediately. You don't have to. But when you answer, it's going to imply what that you are either prepared or you are either sorely unprepared. And
Yeah.
so maybe you can tell us a little bit more about, Bradfield Accounting and Advisory, which when we first started, I was like, Bradfield, I thought your name was Bradbury,
Yeah.
but you have a great story for that. So I'd love for you to tell us, and to tell us, how they could reach out to you, how they could maybe get a preliminary discussion, things like that, because I think we've talked about a lot of things that are going to be like, oh my gosh, this is a lot to think about. I need to get my act together. So tell us more about Bradfield Co.
Yeah, so I'll answer the question about where did the name come from. So
Yeah.
my last name is Bradbury. Obviously, the company is called Bradfield. The origin of that is my wife is also a CPA, and when we first met and started dating, her last part of her last name was Field, and so people referred to us as Bradfield because they knew we were going to get married before we realized we were going to get married. And so when I started the company, given how supportive and loving she's been, and like I wouldn't be here without her, like the name is sort of an homage and honor to her and not just me. Like, yes, I run the business, but I wouldn't be here without her. So it's the combination of our names and sort of recognition of her contributions to it.
I love that. That's amazing. I don't see a lot of business owners do that. So I thought that that was very unique.
Yeah.
But tell us a little bit about more about, are you really an accounting firm, a financial advisory firm? Like, what exactly do you do, Mister?
Yeah, it's a great question. I would say our goal is to meet business owners and founders where they're at. And what I mean by that is whether you're just starting out, whether you're looking to exit, you probably have a need because there's a gap in terms of like the support you've been provided or the experts you have access to. And what we come in and do is help understand where you're at. We help you refine what you're really trying to accomplish. And then we help put a plan in place to achieve that. And the reality is that's not all that creative. Like everyone does that if they're doing their job. I fully acknowledge that. But I think what's important to understand is it has to come from a place of like, what are you trying to accomplish? I stress this more than anything with clients is that you need to know what your end result is. Otherwise, you will never get there. It is amazing to me how often when we talk about what people are trying to achieve and what and how we're going to solve that, that they don't actually know what it is they want at the end of the day. So you asked the question about like, I'm going to tie this back to this, where how do you know what the number is you should have or want for your business when you sell, right? Like you should always have a back of your head, like what's the make me move number for my business? Like what would, if someone gave me the Godfather offer today, what would it have to be for me to walk away? Because, and I had this conversation with recently with a client who they were offered 5 million for their business, which is not an insignificant amount. They were really excited. And unfortunately, I had to kind of burst their bubble because we walked through what they would end up with at the end of it. And it was a couple 100,000. And she
Hmm.
was like, I don't really want to leave this for a couple 100,000 if that's what I'm going to get. She's like, I feel like it's worth more than that. And so, again, you have to know and have thought about this intentionally that that is the case. Otherwise, it's very easy to go 5 million. That sounds great. Let me do this. And it's not until you get the check at the end of the day that you realize, oh, like I just won 10 cents in the lottery. Like, yes, but like I didn't get a whole lot out of this. And it's now I have to go start over to some extent. Like what
Yeah.
I envisioned post exit is not the world that I now have. And I think this is a huge focus of what we do on that sort of financial concierge side is we really start from a place of what is the thing? What is your North Star? What are we trying to solve for? At the end of the day, what's the most important thing for you? And then how do we work backwards from there, knowing that at every decision we make, it's going to get us to that place, whether it's financial, whether it's something else. And that when we have to come up to a decision and you choose A or B, it's okay if you choose something other than what you said you wanted, so long as it's a conscious decision to do that. But I think the risk that a lot of business owners make is that they choose something not knowing that they've chosen it and that's the outcome that they've chosen. It's just sort of like, oh, this is what the answer is without realizing, oh, I didn't actually understand that's what I was deciding between. And so we help them do in that process is get better at the decision making process, help put in the right professionals in place that are working in unison with everyone to make sure that those objectives are being met. And basically, we help ensure that the things they've wanted all along, legacy, wealth, comfort, certainty, are sort of being addressed when it all comes done at the end.
Yeah, and that's where I think crunching some of those numbers then allows you to know what that is. Like even
Yeah.
with my guy, I was like, well, I mean, best case you would ask for this amount. So sure he mentioned that amount and it was like didn't get any pushback and was like, okay, great, let's talk about it. So again, knowing those numbers and having that information doesn't mean you need to parlay it to the buyer.
No.
but it means you need to use it to negotiate better for yourself. So I appreciate all the information that you've given. This has been
Yeah.
amazing. And we have provided your information, so you can certainly reach out. I think we have a lot of other topics that we could also talk about, so we might see you again in the future. But I appreciate it. Do you have any last parting responses or remarks that you want to give, any tips or things to be mindful of?
I'll just emphasize the last thing you said, which is you don't have to like parlay all your information to the client. Like, think of it as you're playing poker, but you've decided not to look at your cards. Like, are you going to go all in blindly? That's probably not a good decision, right? So
Right.
like, that is what you have. Don't just flip them over, show your opponent. Don't like, think of it as like it's a strategic move on your behalf. Understand what you have, understand what they want, understand how you can use the information to get what you want. Because as soon as you disclose it and give it to them, you've lost control of it and
Mm-hmm.
it's no longer your secret weapon. So I think that's really important to understand. Like, it's very easy to get lulled into like, oh, this is great, they're perfect. Like, let's do a handshake. I know they're the right person. Like, everything's just falling into place. And then all of a sudden you've gotten taken advantage of and you're getting 50 cents on the dollar because you weren't strategic about how you approach this deal. I just hate seeing that. And it's really important that you don't fall into that trap.
Yeah. And not to be fearful about it, but there are ways that you can prevent those types of things from happening. So we would just prefer that you do reach out to somebody.
Exactly.
But we appreciate you and we hope to
Thank
see you
you.
again. And
Thank you.
thank you for your time.